everyone, this is Rob Roy with Elliott Wave Options, and welcome to TradeFinder Live. For those of you that are new, welcome. I'll give you a rundown of the procedure, the process that we go through each and every week on the TradeFinder broadcast. But before we get started, take a look at this disclosure. We show this each and every week, so many of you have seen it a lot of times already. If you're new, take a screenshot of it and read it at your leisure. A couple important details that the powers that be want us to make you aware of is that we are not licensed to give individual investment advice in the United States. And because we have a lot of international viewers and subscribers, any prices that we talk about are assumed to be in US dollars unless denoted otherwise. Those are the two biggies. So let's go ahead and get started. Move this window over here and come back to look at your Q&A. So here's the market, and you can see that we gapped up in yesterday's trade. So those of you that have watched before, you know how I feel about gaps. Gaps get filled. It's just that they get filled immediately. Does it take some time? But we had talked about in the last week, as well as in the last S&P update on YouTube, was that the next target was the 61.8% fib corrective level. That's where we are. So we bounced right off of that. So even Friday, we moved off of it and then gapped up on Monday. And then today was kind of a nothing day. Really, other than the gap up yesterday, nothing happened after that. Look how small that bar is. So I think that there's a lot of indecision in the market, just as we, to be honest, have a little bit of indecision as well, as far as where do we go to from here. And that's what happens when you have periods of time where there's still two qualified patterns. So the move down to the 61.8% was expected. That does leave a qualified zigzag pattern, which I really like with the sorry. That's my bad. Let's start over with it. The 61.8% fib retracement level is one that I redo the chart here, is one that I really prefer as far as a zigzag pattern. Moving down, hitting 61.8, because then you don't have the possibility, if you're looking at a 38.2% corrective level, if you're looking at a 50%, you don't have that doubt of, oh, are we going to go down to 61.8? Well, you already know you're there. So it leaves a very small amount of potential risk if the pattern becomes disqualified. And you're probably aware, if you've been watching these, that the target is a 70% corrective level, according to Elliott, means that this zigzag that I've just illustrated would become disqualified. So that's not a whole lot of room to the downside. So you don't have to worry about much of a margin for error there. Your stop loss is pretty tight. And then on top of that, if that does hit, then you've got another 30% move down to retrace all the way back to the previous four, which is the other pattern that is qualified. The 5-wave Elliott wave pattern rule, where when you finish a 5-wave, you move in a corrective move back down to the previous four. And the little tiny piece of caveat here is we've completed this zigzag here. So this zigzag is done, and we're at the 61.8% level. Is it going to extend? Are we going to start a new potential pattern? Those are the questions that arise right now. So in our portfolios for our subscribers, we have two primary ones: an impulse portfolio, which is directionally based. Well, we've just illustrated that the next directional move, the next impulse move in the market is a little bit in doubt. We can even add the moving averages on there, and you can see that even they're all diverging with where we are. In other words, it's like everybody's got their hands up in the air. I don't know where we're going from here. And Elliott isn't convinced, Elliott Wave isn't convinced which way we're going from this point either. The easy move was down to 61.8. We did that. So now what happens from here? So when we have a situation like this, which is it occurs, we have more than one Elliott wave qualified pattern. This is where we look towards our volatility strategy, and that's where the bulk of our new alerts have gone. in finding the consolidating triangles because we don't care which way they go. You find a nice consolidating triangle pattern, and just if it breaks to the upside, great. If it breaks to the downside, great. We don't care on the direction. So that gives us something to focus our attention on while we're waiting for the next directional move to add more impulse trades. So we still have a couple bullish impulse trades on in the impulse portfolio. Nike and Starbucks, they're doing fine. And in fact, we wish Nike would just pull back just a touch more. Would be great from its earnings report. It's already a nicely profitable trade, and we have a butterfly that we'd love to see it move back down within the wings. If it doesn't, we still had a nice profit. So we've covered that before. But so that's where we are. We have this zigzag pattern here with a potential 100% extension up to that 381. We gapped up, probably going to come down and fill that gap, but not guaranteed. We couldn't continue to move higher. Are the debates going to, 4 years ago, people were talking about the debates did move the markets. Are we going to see? The futures are almost dead flat right now. And by the time we finish this, we'll be about an hour into the debate. So I'll give you a rundown if the futures are doing anything as far as something extraordinary coming out of the debates. Possibly not, but maybe. You never know, especially after hours with the volatility that we've had in the after hours market recently. But that's interesting, isn't it? That we're right here at that 61.8% level, which is a beautiful upward zigzag. That's the pattern that I think most people would be shocked over if we did continue higher from here. We're getting all the data that we thought was going to come as we're moving into wintertime. The number of virus cases are starting to tick up. And so is the market going to move up in the face of that? It's just people will look at that and say, how is that possible? Well, the market knew that already. That's no shock that we're going to have an increase in the virus cases moving into the wintertime. They said that back in March when it first came out, that there's likely going to be a second wave in the winter. So it's already factored into the market is what I'm trying to say. So when people shake their head and don't understand how the market can be potentially moving up in the face of all that, well, it's already discounted that. That's why. And it didn't view it to be a significant enough issue. So that's where we are with the current market. I did want to show you the dollar real quick before we move into looking at the website. We did close out a case study since we were together last week, but I wanted to show you the dollar. We came down here, and this is just classic Elliott wave here. So there's the 5 wave completed right here, dead sideways, right down here at the end of the wave 5, kind of that launch pad effect that you've heard me mention before. And we did make a bit of a blast off move in the dollar. That was a bit eye-opening as well. Maybe, going back to that Federal Reserve meeting where they weren't very specific on what assets they were going to be purchasing. They said they would continue their asset purchasing program, but they didn't tell us what. They didn't tell us what they were going to be buying. And so I think the market, and specifically the dollar, may have been concerned about something more elaborate, more grandiose, like what they did when the virus news first came out, where they just, boom, went to zero in one shot and started throwing trillions of dollars into the economy. But at this point, the dollar had a nice move. And if this wave 5 is done, now remember, it went to 117%. It could extend. So we could have an extended wave 5 pattern. Let's see what that, I haven't looked at this. I'm just curious as to see what that rebound move was. Well, 50%. How about that? I promise you, I'm staring right at you. I did not draw that fib retracement before now. I just wanted to show you the dollar because I knew the dollar went back down today. So I was just going to show you this. And there we are, bounced 50%. So that means we've retraced a fib level, and there could be an extended wave 5 to the downside on the dollar. Could be. Or it could just be that we got just a touch overbought on the bounce back. But let's take this off. And I'll show you what I mean there. So let's just walk this back a few days. And there you go. The same thing you've heard me mention, and this is a different security. This isn't the market, but I always say no security in any time frame gets very far away from its 10-day moving average. Well, with that move to the upside in the dollar, there's separation there, starting to create a gap. So what happens? Well, come back down. And what happened on the low today? Dead on the 10-day moving average. So that doesn't mean that the upward move is done. It doesn't mean that the downward move is done either. So we're kind of in between on the dollar, just like we are with the market itself. This is when it requires patience to be a trader. Don't force trades. Let me say that again. Don't force trades. Don't force trades just to be trading. It's not smart, and it's how you lose money. So let the market give you the signals. Let it play out. We have our technical system, and we will act when the technical system gives us the green light to go. We are not going to just put trades on just for the hell of it, just for having trades on. That's not smart. But we do have our volatility portfolio where this is ideal because we're in a flux. We don't know which way we're going to go. We don't care in the strangles. It's perfect. That's another reason, again, why we have both the portfolios. But I wanted to share that with you on the dollar. All right, so talking about the dollar, we did have, and we're going to go through this with you, an alert that we closed this week on SLV. So SLV is the ETF for silver, and boy, the metals have been all over the news, lots of volatility with all the things that the Federal Reserve has been doing, putting all this liquidity in, trying to figure out how the liquidity from the Fed balances out with the correlation that metals usually have with the dollar, and it's just created more volatility. However, on the 16th, we were able to identify this consolidating triangle, a beautiful symmetrical triangle following a big run up in price. And those of you that have followed me for a while, especially with the strangles, know that's my favorite pattern. My absolute favorite pattern, bar none, is when you have a vertical move to the upside and it's followed by a symmetrical consolidating triangle. And I left the Elliott wave on here on purpose, and it turned out to be a good educational experience. Talked about this time after time, and still, as many times as I've talked about it, still get people that will see this and say, well, the wave 5 target is up here. Why do we need to do a strangle? Why do we need to buy the puts? The Elliott wave says we're going to break to the upside. But Elliott himself was very adamant that when you have a corrective triangle, now we just completed a course on diagonals, and Elliott kind of would refer to those as diagonal triangles. Even though it sounds confusing with both using the word triangles, they're not the same thing. A diagonal triangle and a corrective triangle are totally different. So with a corrective triangle, you don't pick direction. So the Elliott wave pattern becomes moot. You don't look at that. You come down here and realize that this could break either direction. We're sitting on a 23% fib retracement level. That's great for generating this triangle. So we know we're right at a support level. Beautiful triangle. This could go either way, hence the triangle. We also, I mentioned this last week, I believe, that we do each and every week for subscribers a webinar like this, interactive, where they can ask questions. It's for subscribers only. We call it our insider event. So subscribers will go through and we talk about each alert that's active or were closed out or adjusted during that week. And then in between, if there's something that needs to be said that's in between the weekly webinars, then we'll post a comment. And this, we can post comments to general market information or specific to individual alerts, and you can post it there. So we try to keep as many lines of communication open as we can. We like the interactive commentary with our subscribers. So in this case, this is what Elliott warned you about, right? This is what we just covered. Even though there was a 5-wave pattern to the upside, boom, we broke to the downside, and then there's that separation again. Remember what I mentioned, no security in any time frame. It's very far away from the 10-day moving average, and this one didn't either. So here's where we were sitting in an oversold scenario. It was a good time to go ahead and take the position off, which we did, which generated just under a 61% gain in 6 days. Now look at this mark-to-market dot plot that we have. Mentioned this before, but this is a really good illustration of it. Even though this trade made 61% in 6 days, it still was at a loss for 3 days. And that's to be expected with those strangles. You're buying a call, you're buying a put the next day, like right here, the next day, you're going to be showing a loss because of 1 day's time decay coming out of both the call and put. It's how they work. It doesn't mean that the trade isn't working. It just means that the stock hasn't broken out of the pattern yet. That's all it means. And then boom, you get the breakout and you generate the gain. So I thought, what a classic example this is of that mark-to-market showing of positions profitability. And again, we have that for every single alert. So really nice position in a short period of time. And I'm going to collapse this back down because I'm going to come back here and share something else with you in a minute. But let's go back now and let's take a look at the SPY, or excuse me, SLV. And you can see that how powerful that 10-day moving average is. So this was the closing day. Put the moving averages on there. There's that separation. The next day, it opened lower, but immediately rallied and closed much higher. There we are, right back up to that 10-day moving average, which is why we sent out the alert to take the profit. And I think that's important to highlight because there's a lot of alert services out there, but a lot of them just tell you when to get in. They don't tell you when to get out. Well, getting out or knowing when to get out is just as important as identifying and finding a position to get in. So we send you alerts whether it's an entry, an adjustment, or an exit. But in this case, at least to this point in time, it looks like we timed it out pretty well on that exit. All right, so let's go back and take a look at a couple of weeks ago. Now we did MTOR, and that one worked out really well. That was on September 1st. Now this was a corrective pattern as well on Texas Instruments. And this one has moved back to the upside with the market. So it's gone sideways here, but it did move back up. So this one is not following the potential move back down to the previous wave 4. Note that we have Fibonacci stuff everywhere here. The wave 4 right at the 38% level. This has moved up past the 61.8% level. Now that can extend 100%. It's possible for that to be an extended wave 5 and extend 100%. You can see this zigzag here. Are you starting to see all these? Hopefully you're seeing these things show up. And that one had an 80% corrective move. So that one would have been disqualified even though it still worked. So this stuff works so much that even a disqualified pattern ends up working. It's pretty fascinating, but it's clearly a zigzag pattern. But moving up and going sideways here, look at the moving averages. We're above the 10, 30, and 50. The 10's moving back above the 30. This is one that if we break this high here, that one would need to be adjusted to an upside position, but not until it breaks above there. So even though it has bounced to the upside, we've already talked about how the market itself could have come all the way back down to this previous 4. That's 5-wave, Elliott wave potential there. And the same thing could happen with Texas Instruments. We get this bounce back to the upside. And, well, the futures just glanced out of the corner of my eye. I saw a bar spike up. So the futures just went up 10.5 points like that. I don't know what was said on the debate. Something somebody liked. But we just immediately had a spike 10 points on the futures. Well, we can finish, down 50 by the end of the day or up 50. Who knows what's going to happen? It's fascinating to see the market reaction like that, especially when I just talked to you about it. We could move back up here, we could test that level and then head lower, or we could break that. But until we break that, you stay with the pattern. Stay with the qualified pattern until it becomes disqualified. That's how Elliott wave works. That requires patience at times, especially when the position's going the wrong way. So we'd be at a loss in this one right now. And really, we haven't had any closed out losers yet. We had one, the HSIC one, that was at a loss for a while and then boom, turned and moved our way. So we haven't had one end at a loss yet in all the weeks we've been doing TradeFinder. This could be one, but if it moves back up here, we adjust it. That's what you do. You adjust it and fix it if it's going the wrong way. So not a whole lot else to tell you about Texas Instruments. We can take a glance at the DMI. The ADX is really not interested yet, but it went sideways for quite a while. Now remember, the ADX lags just a touch. That's when we default for the DMI itself to the two directional indicators because they're more responsive to short-term moves in the market. And this is telling you that there was you can see the sellers were in control. Even when we're going sideways, the sellers were in control, and now there's been a changing of the guard. The buyers are. And if we get this ADX to turn back up, now here's a great scenario for you. And the market doesn't always do the great thing that makes it super easy. But let's say that Texas Instruments heads back up, the market moves back to the upside. These two are separated already, and this ADX turns and breaks back above 20. That's all green lights to the upside. So take off the bearish trade, put on a bullish trade, fix the trade. That's the adjustment process. I will do that as long as I trade because that works. Just not walking away and just absorbing a loss and taking the punch to the stomach. And that's not how you become successful trading. Don't get married to a trade. Don't get upset if it goes the wrong way. You got to take the emotions out. Just trade what the charts tell you. And if you do that, you'll start to realize a lot more success maybe than you even realize that you were capable of because you just take the emotions away from it. It took me a long time to learn that. I mean, I've been doing it 25 years, but it took a while before I got to the point where I could do that as well and just trust the patterns. A CBRE, this one was an upside position, and let me talk about this. This was last week, wasn't it? Yeah. Last week it had moved down, and we had a little bit of a blast off yesterday, filled the gap today. So we'll see how that one plays out. This one here now has the sellers in control. This would be a little concerning, the fact that we had just a small down day, but yet the sellers move back to the upside and the buyers move back away. So the scenario here probably would, if that ADX it's not a really good triangle formation. There's consolidation there. But here are the two targets that make this interesting to whatever position you may have had on to morph it into a triangle. Because if we break to the upside, we're going here. If we break to the downside, we're going here. And there's really nothing in between because it went dead sideways all that time. And then this move here was vertical. So my point is there's really no resistance to the upside. There's no support to the downside. Whatever this stock decides to do, it's either going to come up there or come down here. So it probably makes sense at this time, just take it and put it into a triangle. Don't even wait any longer on the potential bullish move. And then last week we looked at TAL, which I really like. Bit of a breakout move attempt yesterday, and 45 cents. It's tough to call that a follow-through day. It's really not a breakout yet. It's trying to, but you can't really consider that a breakout, at this point in time. But we still have just a really nice descending triangle. We talked about how we may need this one to go sideways just a little bit longer, but I did want to show you this because the question was asked, I believe it was last week, on one that we talked about, on MTOR. Why wasn't that sent out as an alert? Well, this one was. We did send this one out. as an alert to the subscribers. So there it is. So I wanted to share that with you that, hey, you know, the stuff that you're looking at here on Tuesday night sometimes moves into alerts for our subscribers as well. So we're going through and showing you this on TradeFinder Tuesday evening, exactly what I do on a day in and day out basis. So that one was no reason not to send that one out. So we did. And it's just it's a great pattern. I love the fact that all these bars are just big. The stock really moves. And when it picks its direction, I think it's going to be a very significant move. No idea whether it's going to be up or down. That's why we put a triangle on. But I do believe that when this one breaks out of this triangle pattern, it's going to be a really nice move. So that was a really good one from last week. And I think within a couple of weeks, we're going to go back and look at that and say, look at that breakout, look at that move. Now, maybe we have a few more days here. I wouldn't mind to see, I mean, I like seeing these two big bars here, like it's getting ready to break out. That'd be nice. The sooner the better. We always prefer them to break out quickly, but in all honesty, it wouldn't be bad to see it go sideways with a couple more days with some smaller bars, and then have the energy of something like this happen where you get a big move to the upside that, unlike this day, this one was not confirmed. We didn't have a second day, a follow-through day, but to get that breakout with a follow-through day. It's similar to the SLV pattern. It's not quite as vertical of a move, but that's still a pretty good move. It's not a symmetrical triangle. It's a descending triangle. So it's not as classic or as exact of a favorite pattern as that SLV one is for the breakouts, but it's pretty darn close. It's very similar would be, I think, the appropriate way to word that. So that's the updates of where we are. We also wanted to show you these. We wrote these down as, let's look at these. Well, we're just going to keep an eye on them. So we didn't select these, just said let's keep an eye on them and see what happens to them. So I'll just bring them up and let's see what happened from them. And you can see we had this little bit of a triangle here. We're in the wave 4. So this one came off. I believe this one came off the combined search where we're doing the consolidating stocks within wave 4 buy, and it's basically just moved with the market out of this consolidation phase right here, which went way back. So again, another one that's really easy for when you want to make an adjustment or exit the position. If it breaks 260, that's just massive support there. So if it breaks that, then you go bearish, and boy, holy cow, you almost would want that to happen, because look at this. There's nothing there. It's just went straight up in the 45-degree angle. If that 260 level was broken and didn't hold, this thing is going to get cut in half. It wouldn't take very long for it to move down there, which would be a lot of fun to trade that. But it has to break that 260 level and get confirmed first. But right now, it looks like it's following the pathway to the upside. And then the last one that we said we were going to watch was PLCE, Children's Place. I think Carter's was also there, both children's clothes and retail outlets. So here we have this wave 4 here. Now we have, look at this little triangle. So we're building a complex wave here. It's not huge, but it's a $27 stock. So you're likely not going to get huge triangles, but you have a little triangle right there. So this is going to break. Which way does it go? Does it break to the upside? We're at a 46% corrective level. So that's what I was talking about before with the market loving the 61.8% level, because you don't have this piece of indecision of are we going to break all the way up on the wave 4 to 61.8? Well, you could certainly envision a breakout of this triangle and that wave 4 relabeling up here to a 61.8% level. That could easily happen. Or the 46% holds and we break down out of that triangle, and that starts the impulsive move down to the wave 5 target. Either of those scenarios could happen, and that's where we get the triangle again. So just wanted to share those with you because we looked at them last week and said, let's keep an eye on them. So we did. All right, so let's take a look at the pre-computed list and see what we can find. As I mentioned, see there's 5 corrective stocks, 3 impulse stocks. I find that interesting that with just basically, all right, call it 3 days if you count Friday of a bit of an upward move, has already given us 3 impulse stocks. So I'm just curious to see what they are. Well, you got 2 of them that are health related, IDXX Labs and Novo. We looked at that one before. And then NVIDIA. That's pretty interesting. Let's just take a look at them real quick. But I'm going to leave the DMI on there because it looks interesting. Look at the separation between the 2 directional indicators. That's fantastic on this move to the upside here. And it looks like it's starting that 45-degree angle type of a move that I like. And then the ADX, remember from past commentary, I like it when that ADX breaks below 20. It barely did. It's more accurate when the ADX comes below 20 and then crosses back above it. And that sounds like a petty little thing, but it really matters. It makes a big difference if the ADX breaks below 20, curls back to the upside as far as measuring the strength of a potential trending move. So that it's breaking above 20, and there's good separation between those 2 directional indicators. That looks pretty good. Look at that. Money flow has been positive. The money flow was positive even as the stock was dropping with the COVID thing. So that would have been here's the divergence with each one of these indicators. If you haven't seen the Trade Scan series, watch that because we spent an entire webinar on each of the indicators that makes up our technical system and talked about how to use the indicator. And with the money flow, you're looking for divergences. So there can be divergences within this, which actually there is. And then you compare the divergence here as well. So when you see the stock going down like this and money's moving positive well before we ever got down here, and then if you'd have noted the doji here, that would have been a great signal that this is moving up. And you could have caught this one. That we don't catch bottoms and tops, right? We don't talk about that. We don't focus on catching the exact bottom and the exact top because nobody can do that on a consistent basis. Nobody can. No system catches the exact bottoms, no matter what the marketing says. Nobody catches the exact bottoms and tops on a consistent basis. This just happened to be one where you could have come pretty darn close because you had big divergence here, both in the money flow itself and in the money flow as compared to the market. And then you had a doji on this low day here, indecision. You could have certainly said, hey, I think this is worth taking a shot at a reversal here based on just the money flow, and it would have worked. You had the DMI or the ADX above the negative directional indicator telling you that the strongest part of the move was over. So it wasn't still in a strong move down as evidenced by the DMI. So that's one that you could have captured along those lines. But this looks, for where the market is, that looks pretty good. And you can look at anything, drug-related, pharmaceutical, healthcare, all that kind of stuff, and say that those could still do well regardless of what happens to the market in general. If they come out with some sort of a positive spin on the virus vaccine, even though the majority of people say they're not going to take it anyway. So I don't know why we worry so much about the vaccine anymore. It still dominates the talk on the financial networks, but why? Unless they feel people are going to change their mind. But if people stay with what they're saying, they're not going to take the vaccine anyway. So what difference does it make whether we get one or not? So here we have this Nobo in the wave 3. We looked at this one last week, didn't we? Or maybe possibly I did, but I know I've looked at this chart within the last week. And here we have another one that with the DMI, ADX breaking above 20, almost as good as separation, not quite as good as the IDXX lab one, but pretty good. And this one's still in the wave 3, so that puts emphasis on the DMI as well. CCI is nowhere near extremes. It's got room to run. Money flow turning positive. Man, that's surprisingly, both of those actually look pretty good. That's pretty amazing, isn't it? It wasn't that long ago that we were getting none. So let's look at NVIDIA. What a run this stock has been on this year. Is he going to continue? Well, we had the blow off top, and then there's the big correction. Remember, we talk about this all the time. When you get a vertical move, the corrections are more volatile. So boom, straight up, straight back down, all the way back to where we've went. And this is like, why does the stock even bother to go vertical like that? Because it always gets retraced. So here we came back down to this support level, 31% fib level. Didn't quite make it to the 38% level. The ADX above the positive directional indicator, so the strongest part of that move was over, and we would have known that already because of that vertical move. We came back down, and it's curling back up, and it got below 20. It hasn't broken back above 20 yet. Sure looks like it's going to, but you may have heard me say this before as well. Don't just assume that because, okay, we have good separation between the positive directional indicator and the negative, the ADX is curling up, it's going to break above there in the next couple of days. Don't make that assumption. Let it actually trigger. Let it actually do what it's supposed to do before you make the move. So that one would go on a watch list. But these other two here, those look pretty decent. Let's look at the corrective moves as well. I'll put the support guys on the spot, but I'm curious as to if we could pull up a poll on whether or not you would want to do something impulsive or corrective. If not, it's no big deal. We'll just find the best chart. Just curious as to what you guys are thinking. I don't want you to flood them with answers, but if there was a way to create a poll, that would be cool. All right, so looking at Parker Hannafin. Now remember, with the corrective moves, one of two things can be happening. We have the displaced moving average that's been broken, so we know we're doing some sort of a corrective move. Now, does the corrective move come all the way back to the previous 4? Or is it a corrective move within the wave 5 where we're looking at maybe this is some sort of a zigzag where it could continue higher? That becomes the key. And I just don't really like this pattern. It's not really classic Elliott wave stuff there. You could say this was a decent corrective triangle. You give that. Then the thrust move out here. And then an expanding triangle. So that's got volatility strategy written all over it, but as far as picking a great impulsive move, I think we could do better. Let's go back and see what's next. STOR. Gap down, went back, filled the gap. Back to test the displaced moving average, which is interesting, and then filled this gap. So look at that, in 2 days we filled 2 gaps. So yesterday we filled this gap here, and then today we filled the gap from yesterday. So that's the whole gaps get filled, and quite often they get filled right away. Not always though, but often they get filled fairly quickly. The ADX is coming back down, and the two directional indicators aren't giving us much of a signal one way or the other of which way we're going to go. We're just kind of in the middle of the road here. STOR Capital. I'm not familiar with this one anyway. This was a really nice move here, though. That was great. Love to see those climb up like that. And we have broken back and are now testing also the recent wave 3 high. So we broke below it, got back above it yesterday, and closed dead on it today. Well, I don't see anything that looks super inviting there either. JCI, Johnson Controls. That's an 87% wave 5 extension. That was getting pretty close, and look how long the ADX stayed overbought, and then it just kind of like, all right, we're done. Strongest part of that move is over. Let's put the rest of the moving averages on here. Breaking below that 50-day moving average would be a great entry. Look, we still have a pretty decent gap hanging around back here. That one got filled, but that one didn't. So this would be watch it to break that 50-day moving average. I like the way the ADX is just diving down. We've had a little bit of a kiss there between, you've heard me talk about that before, how those two directional indicators will just come together, and it's amazing how often that happens where they come together and kiss and move back the opposite direction. Well, there it is right there. So looks like maybe the sellers are starting to take control. It wasn't a really authoritative bounce that occurred yesterday with the market. So I think I'll put this one on the watch too, like the other ones. JCI, break of the 50-day. That would be a really good entry because there's a lot of room to the downside for that. Look at that triangle too. You see the triangle there? Right here. And look what happened. Look at the breakout that occurred from it. That's why we look at these. That's why we like the triangles. This is interesting. Moving into the winter time in Columbia Sportswear, you would think that would be a good seasonal time for them, but this one, pretty significant move to the downside today. Average volume, so it wasn't blow off volume. Sellers are taking control. So from a corrective pattern, that's the best looking one that I've seen. Right at, just call it the 62% fib level, so that's major resistance. Really interesting from a seasonality standpoint. It'd be difficult to imagine this one struggling like that, but that looks pretty good to come down on the previous four. So target of about 10 points, 11 points, 86 down to 75. That looks good. I'll make a note of that one too. And Dow. Now this one, you have both of the directional indicators moving to the downside. And that was on a down day today. So that's not the confirmation you'd want to see. So if these turn and change, the ones that are close, they're going to show up on the search again the next day. So you don't really have to write everything down on a watch list when you have something like this. When you have one that's really close to triggering and you want to keep a special eye on it. But some of these other ones, to continue to move in the direction that we need them to, will show up on the searches in subsequent days. I just want to run this real quick and then we'll take some questions. Look at all this stuff. Some really cool stuff coming. If you don't have ProfitSource, do you see what that says? AI score. And it's getting ready to be released. We'll be talking about that sometime in the future. That is so cool. You can't believe it. All right, so we still have, oh, let's look at, I always like it when Alibaba, we've done really well with that one. That one shows up in Autodesk too. Yeah, that's not that fantastic of a pattern. Let's see what Alibaba looks like. Remember, a lot of these I'm seeing for the first time with you. We just updated. So the ADX is going down, diving down. That's nice. So I mentioned about how this one shows up a lot. It's almost like GLD or SLV, the way Alibaba consolidates and breaks out, consolidates and breaks out. It's interesting. So we have, this is now a bit of a, see if we can draw it there. Descending triangle, there you go. We'll take this off. And see how expensive that is. Does have December options. All right, well, it's not as bad as I thought it might be. Definitely going to have to drop down on the delta, lower than I usually like to go, but it's doable for this stock. The way it moves in a relatively short period of time. So it would be a borderline expensive strangle with lower deltas, but if it moves enough, going out to December is part of it because that's 80 days out. That's just really, that really looks good. So we're going to watch that one too. $9.29. All right, so let's I think NVO is the best looking one. Yeah, there's options there. Spreads are a little wide. So this would just be contingent on the fact that the spreads tighten up when the market opens. There's enough open interest that they should. I'm surprised they're as wide as they are with, I mean, there's some open interest, but provided that the spreads aren't super wide, so we'll put just a little bit of an asterisk on that. And then the other thing to look at here is broken above resistance. So it was in a trading range for a while, and it's broken to the upside. The DMI looks good. So we'll keep that one as our case study this week. All right, a few minutes for some questions. Viva we looked at, so let's look at UPS. How happy are UPS, FedEx, even the US Postal Service that Amazon came along? It's amazing. Well, this one had the big move to the upside following a blowout earnings report and consolidated it for quite a while. Let's see how far away we were from the 10-day moving average back here. See, that was pretty significant here. Let it gather some steam and then took off again. Back to test that 10-day moving average. And then we broke below it in today's pattern. So just below this level here. Woo! Boy, that's tough. That ADX is way up there. So, and I know it's had a heck of a run, and it's consolidating this, and there's that blast off. But remember, again, blast downward as well from that sideways pattern. And maybe it catches itself and takes off again, but there's just no way that I could go long this stock personally with the ADX way up there. It's just astronomical. It's above 70. You rarely see that. You rarely see an ADX get above 70, especially when I've changed the periods from 14 to 13. That tends to constrain it just a little bit. So it's just the strongest part. It doesn't mean it can't go higher, but it means the strongest part is over. I couldn't do anything to recommend going higher there or to put it out as an alert. Mike says, we already know what the debaters are going to say. We had the opportunity to learn something during this hour. Well, thank you. I hope you have, and hope it's been a useful hour of your time. The volume on BABA is usually pretty good, but let's take a look. So it's below its 200-day moving average, but it's heavily traded. It's a heavily traded stock. So this below average here coincides with the fact that it's consolidating. But you can see that back here, when it was moving to the upside, the volume was much higher. So actually, if you're in a consolidation pattern, you want to see the volume drop off because that goes along with consolidation, and then the potential breakout hopefully comes on volume spike, just like it did here. See where we had this thrust move out of that triangle was met with this above average volume here. That's what you want to see on the breakout to the upside. But good question. Micron, we haven't looked at that one in a while. Let's take a look at Micron. Well, we had a triangle back here. A nice breakout. Man, that one just missed. So nice breakout there. And this is what happens with the triangles. When they break out, the move will be retested. So, or retrace, I should say. So the breakout move will be retraced back to the point of the breakout. It's just an interesting aspect of triangles. But as with gaps, there's no rhyme or reason as to when that's going to occur. If it happened this fast all the time, when we had this kind of a move, we had a strangle on and break to the downside, we take the put off and hold the call for the rebound. But it doesn't always happen this quick. It's fun when it does, because periodically we do that, but you just don't know how soon it's going to be. So I tend to leave it to where the options are priced as far as whether or not it makes sense to close out an option, or if it doesn't have a whole lot of value, you might as well hold it and see if it reverses back to the upside. So the decision becomes more based on the pricing of the option than anything else, because again, there's just no rhyme or reason as to when we're going to go back up and retrace that. But as far as where we are now, we're kind of in no man's land. We had this zigzag pattern. There's the 100% extension. Tried to break above it. Came back in. Now we've tested the 61.8 a couple times, and now we're back above the 100 level. So you could easily make a case that, all right, that's the testing gap here that I hate if you're bullish. But you could certainly make a case for, all right, we've tested the previous fib level. That means we're going to extend up to 138.2 or 161.8. And 161.8 also happens to be where that previous wave 5 was. So that you could see that very easily happening. The ADX, so here's one I was talking about. Way back below 20. Now we've broken back up above 20 because we were up here before. Then on the downward move, it came back. Now it builds up more steam that way. And the ADX is curling up. Now that one was pretty responsive. Sometimes an ADX doesn't move that fast. Remember, we were talking about how it's a bit of a lagging indicator. It did here, and really good separation between the two directional indicators. So Micron looks ready to go up to that 138 or 161 level. NXPI. So this one's difficult. It's 26% wave 4 corrective level. Elliott preferred 38.2, although acknowledging that 23.6 is a fib level, so technically that counts as a correction. Just preferred it to correct 38.2. And then with this move here, you could make an argument, but it really looks like a diagonal right there. That looks like a diagonal with, man, you could even extend that one out. And this be the blow off top part here. Yeah, that, I'm pretty sure that's a diagonal there. But looking here, this corrective move, once you get this blow off top part out of it, it's tested this 120 level a few times. It would be surprising not to see it at least come down here. And the ADX just looks like this one wants to churn for a bit right now. Maybe it'll form a triangle to where you could trade it in either direction. So I'm not more definitive on this one, but the pattern is just not. You complete a diagonal, which really was technically a very nice run in that wave 5. And then you have the corrective move from there. This is a flat right here. This correction here is a really nice corrective flat. Well, I mean, it could break and go higher, but the DMI has some work to do before you can convince that. But that's so classic. Glad you pointed that one out. We just released our diagonal class, and that'll mean a whole lot much more to you once you go through and look at that class, because it's a pattern that doesn't get talked about nearly as often as the wave fives and even the corrective waves. I think we've done a pretty good job of bringing the corrective patterns, the triangles and the zigzags especially, to the forefront. But still not a lot of people talk about diagonals, but we'll be talking about them more now that the class has been sent out. James asked a question of if some fills are at a higher price than you want. You know, time is of the essence, especially when you have the VIX trading up at 28 and prices move, and they move instantly. And sometimes the prices move higher than where the alert was sent out. That's why we post our actual fill price on the website as well. So the alert goes out. We don't front run or anything. We're not placing trades before the alert's sent out. We don't do that. So everything goes out together. Then actual fill prices are noted on the website. But the rule that I think you're asking for, James, is it's not so much a rule as a guideline, because again, it can't give individual investment advice, but the guideline is as long as you can get filled within 10%, and that's above or below the alert price that's sent out, go ahead and put the position on. But if it's already moved enough to where it's more than 10% of what the target price was sent out in the alert, just let that one go. If it's moved against us more than 10%, then we may have been wrong. So if it's moved in our direction more than 10%, well, then that's a chunk of the profit that you'd likely miss out on if we did indeed close that out as a profitable alert. So it's a good question, and that's the guideline. As long as you get filled within 10% of the price that's sent out in the alert. So thanks, everybody. Again, for all of you that attended live, thank you so much. I appreciate it very much. For those of you watching on the recording, hope you still found this informative. I think we noted some pretty interesting things this week, as we do each and every week. And I hope you have a terrific week. And by next week, when we get together, hopefully we have a little better direction on which of the qualified S&P patterns is going to lead the way. Take care, everybody. See you next week.